Hello, welcome back to Retirement Clarity Radio. I am your host, Scott Newhouse. Thank you so much for joining me. I'm excited that you're here. Shout out to you and the dozens and dozens of other people all across the country and the world that are tuning in. So as I said last week, we're going to be talking about investments probably for the next 3 to 4 more episodes. And today we're going to be talking about a really important topic, which is active investing versus passive investing. What are they? Which strategy is better? What should you use as you get close to retirement, as you enter retirement, as you try and create that retirement paycheck? What's going to be the better option for you? So that's what today's episode is about, active versus passive investing. So if you ever want to start an argument among wealth managers, people that manage money on a daily basis, just ask them what they think is better, active investing or passive investing. Now, while a lot of investing arguments can be settled rather amicably and pretty easily, this debate has led to a lot of publicized disagreements, including wagers between Mr. Warren Buffett, the head of Berkshire Hathaway, really famous investor, and a hedge fund manager named Ted Seeds. Ted, I might be mispronouncing your name there, but my apologies if I am. So back in 2008, the Oracle of Omaha, Warren Buffett, bet that no set of 5 actively managed funds could outperform the S&P 500, which is a passive investment strategy that basically tracks the 500 largest companies inside the U.S. And Buffett said that over a 10-year period, that S&P 500 would do better than any 5 actively managed funds that someone wanted to pick. So a hedge fund manager named Ted Seeds took him up on it, and Ted picked his 5 favorite hedge funds that he thought would outperform the S&P 500. Now, to make it a little more exciting for these ultra-rich people, they decided to each throw in $500,000, so $1 million total, and then the winner would get to decide which charity that money would be donated to. Now, what was the outcome? I don't want to give that away right now. First, I want to understand why this is a major topic and let you decide whose side of this wager you're going to be on as you approach your retirement. So, what is active investing? Active investing is basically when funds or investments are actively managed by an investment and financial experts. And most likely it's actually a team of experts. The aim here is to develop a sort of stocks that they think are going to outperform an index, which is what their benchmark is. So the most common index that active fund managers try and beat is the S&P 500, which again makes up the largest 500 companies inside the US. Now, despite what some online influencers on TikTok and Reddit say, this is a lot harder than it sounds. It's a very complicated process that involves qualitative as well as quantitative analysis to try and figure out which stocks are undervalued, what the market swings are going to be, and what kind of economic forces are in play that would affect what investments they pick. So the success of active investing depends on a manager's ability to accurately determine when stocks should be bought and when they should be sold consistently. And consistency is that key word right there. Sure, because you can get one stock pick right one time, but if you can't do it consistently, there's absolutely no way that you're going to outperform over time. Now, from my own experience as a financial planner, especially over, I think I started 7 years ago this month, a lot of people have stories when they of picking a single stock or two that has gone up the last few years, and they might get a little overconfident. But here's the thing, the entire US market has done extremely well over the last decade, and especially the last 3 years as I record this in February of 2022. So as of me recording this, the average annual return of the S&P 500 the last 3 years has been 24.88%. That's an absolutely incredible return to get on an average annual basis. And no, it's not going to last. You and I both know we're not going to get those returns from now until the end of time. So anyone who's picked single stocks in the last 3 years or so has really benefited from every single thing in the stock market going up. So yeah, you might have gotten a good winner here or there. And yes, you may be very smart, but honestly, let's also consider that the market overall has been going up, and that probably has contributed to you having your investments go up. Okay, so that's active investing. Now let's talk about what passive investing is. Passive funds simply track an index and they match it as closely as possible. However, this is not to say that there's no human involvement at all. In most cases, there's fund managers and investment experts that are required to make minor alterations to make the fund track the index that they're trying to track as closely as possible. So passive investing largely is a long-term approach that follows a buy and hold strategy. I actually prefer buy, hold, and monitor the investments. But yeah, it's a buy and hold strategy. So what that means is that you are not buying and selling depending on the ups and downs of the stock market. It also means that you're not analyzing single stocks to find out which ones will do better than the rest. Instead of picking a few single stocks that you think are going to be winners, passive investors buy very, very, very small pieces of thousands of different companies, and they enjoy the increase in value that those thousands of companies have over time. So people who buy into passive investing acknowledge that they won't quote-unquote beat the market, since that's not possible because the whole purpose of passive investing is to track the indexes. It's to track the market, not to beat it. So you're not going to beat the market with passive investing. And people who buy into this are perfectly okay with that. Their goal is not to get the highest return possible out of all the available investments in the world. Their goal is to get solid investment returns, typically by owning a few different passive investments that track different things, and that's going to help increase their diversification, which is going to help increase their returns over time. So that's passive investing. Now, let's talk about the pros and cons to each of these. Given their respective backgrounds, it's pretty clear what type of investing, at least in my mind, should do better. But before I give that away, and I know you can probably guess which way I'm going to lean on this, we need to look at the pros and cons of each of these different types of investings and see how it impacts investors. The first thing to think about if you're going to do passive versus active investing is the fees, because both investment types require fees at some level, because there is some management, there is folks who are doing who are using their expertise to do what their job is. And so that's going to be called an expense ratio or a management expense ratio. There's similar terms for it, but that's essentially what it's called. And that is how much a fund is going to charge for their services. Now, understandably, actively managed funds charge more because they're simply doing more. They're trying to find those single stocks that are going to outperform over time. Now, as I looked into this, there's a lot of different studies out there, but according to Vanguard, in terms of fees, the average passive index fund fee is around 0.24%. That's the average passive index fund fee. And according to Morningstar, the average actively traded mutual fund averages around 1.45%. So, wow, that's over a 1% difference between active and passive. And so, given these higher costs charged by actively traded funds, they need to deliver higher returns to justify that excess fee, which frankly, it doesn't always happen. And also, there might be some actively traded mutual funds that cost a little bit less, but if there's a difference between those passive funds and those active funds, again, those differences in the fees might seem small. Maybe it's 0.3%, 0.5%. That might seem small, but if you add that up over decades and especially multiply it by whatever money you have invested in the stock market, it's going to add up to a lot of real term dollars. So really look into the expense ratio, and you've got to analyze, is the actively managed fund going to justify the excess in fee that it likely has? The second thing that we need to look at in terms of pros and cons is flexibility. One major downside of passive investing is that the fund is unable to react when there's a problem in the market, or a fund manager thinks that there's a problem in the market. So let's take 2020 for example, and let's go back to the initial days of coronavirus in March of 2020. And especially about the cruise liners and the tourism industry, which the global pandemic going on, people don't know what's going on, afraid of traveling. Obviously, their stocks are going to get knocked down in value. So while those companies were going down in value, like everything else, but there was nothing that a passive index fund could have been able to do about that in the short term, because a passive index fund's not going to remove cruise liners and tourism related companies from the index, because all it's trying to do is follow the index. And if it's in the index, that's what they do, and they're going to follow it. So they're not going to remove that from that index. An actively managed fund, on the other hand, could have hypothetically withdrawn all of its shares in, I don't know, Royal Caribbean, for instance, and then put those put the proceeds into something like a Tesla or Netflix. Now, admittedly, this is not something that happens all the time. And even when it does, those actively managed fund traders have to have the foresight to know what to sell, and then they have to know what to buy. And if you can pull that off, which frankly most people cannot pull that off, but if you could pull it off, then those kind of moves could have an increased boost in your returns. So flexibility, especially in terms of what's in and what's out of your portfolio, that is a big difference between passive and active. Now, the third thing that I want to point out here is transparency. So it's always wise to know what stocks your fund owns, but you're only able to know that with 100% certainty is when you invest with passive funds. Actively managed funds can actually move funds on a daily basis, as you imagined. They're doing this on an active basis. And they are only required to report what funds they own at the end of the quarter. So let's say January 1 until March 31st, that's the first quarter of the year. They can buy and sell numerous different things throughout that quarter, and then they just need to report what they own at the end of March 31st. But just because they own something on March 31st does not mean that they owned it for the entirety of the quarter. And so it's really harder to track what you've owned throughout the quarter. So if you want to know exactly what you own on a consistent basis, passive funds are going to be your best bet in terms of the transparency. Now, the next thing that we have to consider is active risk. The major indices, the Dow Jones, the S&P 500, they have performed really well over the last several decades. We absolutely cannot predict the future market performance, and we also know that historical performance of the last few decades does not guarantee future performance. But what I can say is if the past does hold true, not a guarantee, then we can expect a pretty decent return from owning a well-diversified group of index funds over that long period of time. However, given the constant changes with active investing, there's a lot more risk involved. You could potentially outperform all of those indices, all of those passive indices, but it's not a guarantee. And there's a more than decent chance that you will not be able to outperform those passive indexes. So active risk is something that you really need to consider as well if you're leaning that way. The last thing that I have for us on the pros and cons is tax efficiency. A passive index strategy where you buy and hold and monitor is very tax efficient, as you're only going to pay capital gains when you're ready to sell. Now, there may be some very small distributions if a company was replaced in that index, and then you have to get a new one. So if you sell one, you may have some very small capital gains on removing one of those companies and then adding in the other one. But those distributions are usually quite small, and they don't happen every single year. On the other hand, if you're actively investing on your own, or if you have a fund manager that actively trades for you, you're likely going to have to pay short-term capital gains tax on every single year. And that short-term capital gains is going to be taxed as your ordinary income rate, not the lower long-term capital gains tax rates. So if you happen to actively trade over time consistently and you have those higher tax bills are going to eat into your after-tax returns. And so you really got to consider that as well if you want to do the active trading strategy. So, to answer the question that we started out with at the beginning, which investment strategy has the better returns? For many years, active investing has been a very popular option for investors because they want to beat the market, even though the S&P 500 and other indices have done quite well over that time period. So, over the last decade, the S&P 500 has yielded 13.6% annually, yet for some investors, that's not enough, especially as it's not uncommon to hear those clickbait stories out there about active funds that have yielded more than 100% in a given year, which has absolutely happened. No, it's not the norm, but it's happened. However, the question isn't whether an active fund will perform better in 1 year, because you and I are not investing for a 1-year time frame, but we're investing for a long period of time. And the simple answer as to whether an active fund is going to outperform over the long term is no. The reality is that consistently outperforming good, low-cost passive index funds is extremely difficult. So from mid-2020 until mid-2021, that was deemed one of the best 12-month periods for actively managed funds. Yet, only 47% of them outperformed passive index funds, and that's according to Morningstar's active/passive barometer. And that's the best that they've done in a while. So their very best is outperforming, is only having 47% of actively managed funds outperforming their passive counterparts. So that's really just not that good in their best years. In the past decade, if we extrapolate more than just a 12-month period, only 25% of active funds did better than their passive competitors. And when comparing large cap equity funds like the S&P 500, that number that outperformed drops down to 11%. So only 11% of large cap funds that are actively trading did better than the S&P 500. And so the higher fees are absolutely part of the problem in terms of why active funds underperform passive funds. But the reality is that most stock pickers, even if they spend 40 hours a week doing this, they are not that great at it, which is also why, sadly, maybe not so sadly, I hope they get other jobs, but 40% of actively managed funds go out of business within the first 10 years. So even if you do find one that's going to outperform in a year or two, honestly, there's a decent chance that they may not be in business a decade from now, and then you're going to be left in a situation where you have to find yourself all new other investments. So what does this mean for you, the average investor? It means that it is possible for active funds to outperform passive funds, but there's no guarantee, and in fact, the odds are really stacked against you and against the active fund manager. So to me, that means passive index funds are your best bet. Now, let's get back to the very, excuse me, let me get a little sip of water. Let me get back to the question I asked at the beginning. Who do you think won that bet between Warren Buffett and Ted Seeds? Well, as you may have guessed, Warren Buffett did, and it was not even close. At the end of the 10-year period that they tracked this, Buffett's pick of the S&P 500 got around a 99% total return over that 10 years, which on a yearly annual basis is around 7.1%. Mr. Steeds and his 5 actively traded managed funds, they got a total return, get this, of 24%. 24% over 10 years, that's around 2.2% annualized per year. So like I said, this was not very close at all. To put this in perspective with actual dollars and cents, let's compare what it would have looked like if you had started that 10-year period with $100,000, did not contribute anything after that. If you did the S&P 500 strategy favored by Warren Buffett, you would have ended up with around $198,000 and some change. I'm not going to read out the change. So $100,000 all the way up to $198,000 after 10 years. That's pretty darn good. Good. Now, under the 5 actively managed funds favored by Mr. Seeds, at the end of 10 years, you would have had $124,000 and change. So that's over a $74,000 difference just by picking low-cost, well-diversified funds where you're not trying to time the market, you're not trying to beat the market. You're just trying to get solid investment returns that are going to give you a comfortable lifestyle in retirement. That honestly sounds like a winning strategy to me. I do hope you agree with me that that is the best strategy as you plan for your retirement and enter your retirement, to have those low-cost, well-diversified funds to help you create the retirement income, that retirement paycheck that you want. As always, if you want help making sure that your investments are sound, I'd be happy to help. You can schedule a call with me at startmyretirement.us and we'll create a one-page financial plan and retirement plan for you. That's all I've got for today. Thank you so much for listening. I'll see you next week to talk even more about investments. Bye. Thanks again for listening. As a reminder, you should consult with a financial advisor familiar with the specific circumstances of your unique financial situation before making any financial decisions. Nothing in this podcast is a solicitation for the sale or purchase of any securities. any mentions of rate of return are hypothetical in nature and not a guarantee of future returns. Scott Newhouse, CFP, is an investment advisor representative of Forthright Finances, a California and Nevada registered investment advisor.